Like and subscribe and click the bell icon to get new video updates.
The RBA will raise interest rates, but not to the alarming levels the experts are predicting. A week ago, barely anyone was talking about a pre-election interest rate hike. Now, there is a tsunami of professional opinion pointing to a lift in the official target cash rate on Tuesday, following last week's dramatic rise in inflation. Prices now are growing at their fastest in 20 years. For a government campaigning for re-election on cost of living pressures, the March quarter numbers delivered a hammer blow. Perhaps not fatal, but hugely damaging, nevertheless. An official hike would merely add to the pain and heighten the political embarrassment. But there is one thing the forecasters have overlooked. It has nothing to do with the independence of the Reserve Bank of Australia and its desire to remove itself from the political process. It is this: the RBA really doesn't want to raise interest rates, at least not to anywhere near the levels many now believe are inevitable. Certainly, there is a logical argument that with unemployment below 4% and headline inflation above 5%, the economy appears to be overheating. Under those circumstances, there is no justification for emergency-level rates at 0.1%. But during the past 30 years, the RBA, in association with the banking regulator, the Australian Prudential Regulatory Authority, has helped create one of the globe's biggest asset price bubbles. And if it unravelled, it would wreak havoc with the financial system and the economy. Australia now finally is captive to real estate. We aren't the only country to have allowed this to happen. But we are one of the most egregious examples. Our banking system, which for decades has prospered on the back of soaring property prices, has become hostage to a $9 trillion monster. And while our politicians for years berated each other over relatively insignificant levels of government debt, they conveniently ignored Australia's real economic Achilles heel, household debt. That has now hobbled our central bank. It can raise rates to anywhere near the level it may require without causing utter chaos. Perverse as it may seem, our perilous personal debt situation could be the saving grace for those who recently geared themselves up to the eyeballs. We simply can't afford to have so many go broke. Rocks and hard places money markets are in meltdown mode. Bond investors, here and across the globe, have suffered enormous losses as a decades-long boom suddenly has reversed as inflation has awoken from a 30-year slumber. These are the markets that ultimately determine how much we pay to borrow cash. And if you believe them right now, official rates are on course to hit 3.5% by October next year. That is the equivalent of 14 rate hikes in 16 months. Given our booming labor market and accelerating inflation, there is a certain logic to their argument, but it ignores one vital bit of the economic puzzle. Rate hikes of that magnitude would send vast numbers of Australians, mostly young, recent first home buyers, to the wall. It would severely depress the housing market, in turn putting the banking system under enormous pressure and plunging the economy into recession. That is just not going to happen. Here is a graph the RBA published a few weeks ago. The left-hand side shows how rich we've all become as real estate has soared when compared to our incomes. On the right is the trade-off. Australian households are carrying record levels of debt, secured against those expensive houses. It truly is a house of cards. If you think that is concerning, bear this in mind: the debt numbers are averages. While it shows household debt heading into record territory at almost double household income, vast numbers of young Australians last year were allowed to borrow up to 6 times their income. Around $500 billion was advanced during the pandemic. If you need any further convincing, check out the extraordinary lending spree our banks indulged themselves in during the pandemic, all under the watchful eyes of our regulators. That dramatic lift in owner-occupiers largely comes from first home buyers, most of whom believed there wouldn't be an official rate hike for at least 4 years. The banks thought so too. Safe as houses back in 2017, when real estate appeared to be heading to the moon and beyond, the RBA and the banking regulator engineered a slowdown in national property markets. They simply made it more difficult to get a loan. You can see the impact in both graphs above. The banks advanced less money, particularly to investors, and prices began to moderate. For a time, it appeared that we may have been able to achieve what many thought was impossible: take the heat out of real estate without serious economic side effects. The pandemic changed all that. With forecasts of a 20% property slump by even relatively sober analysts, as the economy plunged into